Hello and happy January 10th. This is the day of the big USDA set of reports, the biggest data dump of the year from USDA. So it's known for its surprises, and USDA didn't disappoint. This is Arlan Suderman, Chief Commodities Economist at StoneX. And we're going to talk about those surprises in today's report. But first, we're going to put it in the context of the market that we had coming into it. What was the money flow? And as those of you who have followed me before know that I believe that money flow is a big part of it and how the market is going to react. Price is a function of supply and demand. The market still is impacted by supply and demand, but how the market manages supply and demand is impacted by the flow of money. So we're going to take a look at that to start off with. First of all, we got the big monthly jobs report this morning showing that the unemployment rate had dropped to 4.1% in December. Job creation was about 100,000 jobs more than what the analysts expected. And the November and October numbers were revised higher as well. So the job outlook is looking better, and that reduced the odds that we'll see a rate cut from the Federal Reserve anytime soon. Now, as we look at the inflation numbers, the latest inflation numbers available, we still do not have the December inflation numbers yet. We see that inflation has started to tick higher again. Is this an aberration, or is this more of an extended trend? That's the key question the Federal Reserve is trying to determine. Their comments seem to indicate overall what their general comments from their statement is that we're still heading toward a 2% mandate. Individual members of the Fed aren't convinced of that. And so based on the minutes of the meeting, it looks like we're getting closer to more of a 50-50 split, which would suggest that we're looking at a pause in the rate cutting cycle. It's interesting to note that we have seen the Fed since September 17th cut their benchmark rate, which is a short-term overnight rate, by 100 basis points, with originally expectations to go another 100 basis points or so lower. But that is kind of blown away in the wind right now. But meanwhile, we have seen yields on 10-year treasuries in that same period of time that the Fed's been cutting 100 basis points go up by about 115 basis points, go in the opposite direction. So that tells us, and I've got a chart to show you that in a little bit. I'm going to jump ahead to, no, I'm not going to jump ahead to that. Let's back up here. I'll come back to that. This is again a chart that I've been maintaining showing inflation following very closely, albeit on a different scale, the cycle that we had in the 60s, 70s, early 80s. Now, just because it's followed it to this point doesn't mean that it needs to continue to follow it. But human behavior does repeat itself, and the Fed did give in and cut rates, in my opinion, too soon, too much. So does that mean that we have now overstimulated the economy? Now, this chart didn't know who was going to be elected president, but we elected a president who favors tax cuts and deregulation, which tends to stimulate an economy at a time when we're cutting rates, which is also stimulative of an economy. We still have a lot of fiscal stimulus in the economy. So that means that in order to try to reduce inflationary impacts, we need to see a cut of fiscal spending. Will this administration be successful at doing so? They've established the Department of Government Efficiency with a goal of cutting government spending by 30%, but will they be able to accomplish that? And that's a big question going forward. Now, as we look at why is the economy doing so well? Well, 70 to 75% of our economy is based on the consumer. It's a consumer-driven economy. And look what's happened to, this comes from Real Clear Markets in their survey, their economic optimism index. Look how it has spiked since the election to more optimism. And that means consumers spending more, generating energy, the animal spirit, so to speak, of the economy. And that can be inflationary if you have too much money in the system when that happens. Now, where are they getting that money from? Well, first of all, while interest rates have gone up excuse me, while the Fed has cut interest rates at since September, that is, they had raised them prior to that. So mortgage rates are high. And now with 10-year treasuries, they're going higher again. The average rate on a mortgage in the United States right now is right at 4%, with home values going up. So that means the consumers have more wealth in their assets. And when they have more effective wealth in their assets, it's the wealth effect, they tend to spend more. And that's what we're seeing happen, in addition to the fiscal spending. And so why hasn't it slowed down the economy at the corporate level? Because corporations are able to lock in interest rates. And with interest rates near zero for so long, they did so. And they locked in interest rates at very low levels, and which is what we see in this chart. We're seeing corporate net interest payments near record low levels. I mentioned home equity lines of credit are expanding because they have so much equity in their homes. Homes going up in value because we have a shortage of houses in this country. And so values of homes values keep going up despite the sluggish housing industry. The values keep going up, making new record highs, even though homes aren't moving, because every time we do see a dip in interest rates and consumer sentiment go up, we see a surge in demand. And so house prices are staying up there. Equity lines are there because equity is growing. And so consumers have more to spend from that standpoint. Now let's look at the fiscal side of it. We're basically locked now at this 36.3 trillion dollar national debt. That's because the agreement reached between Congress and President Biden in June of 2023 to suspend the debt ceiling until January 1 of 2025. Well, it's now after January 1, 2025, so we can't borrow anymore. But we're still in deficit spending. So that means the Treasury Department is currently needing to be very creative in its accounting to move money around to try to pay its bills. And it can do that for a period of weeks, but it can't do that forever. And so therefore, Congress is going to have to deal with the debt ceiling. They've got to cut spending, increase revenue, suspend the debt ceiling, raise the debt ceiling, whatever they're going to do, they've got to do something here in the weeks ahead. And so one of the priorities of the Trump administration is to get Congress to come to some type of an agreement on that. If you look at the center there, we see that the annual interest on that debt is at $1 trillion. That's more than what we spend on defense each year, $871 billion. Social Security is $1.5 trillion per year. Medicare, Medicaid at $1.66 trillion. You add those four things together, which to some extent are somewhat untouchable, and it comes to about $5.03 trillion. But look up here in the center of the top, where U.S. federal tax revenue is projected at $9.4977 trillion. So those four things alone put us in a deficit, and we haven't even touched the discretionary part of the budget, USDA programs, food programs, Homeland Security, Veterans Administration. I could go on and on and on about the rest of the discretionary programs, which are about another $1.75 trillion. So if you're going to cut the budget by 30%, you essentially have to cut all of discretionary spending. That's not likely to happen when that approval has to come from people who want to get reelected. That's the problem right now. Right now, our annual deficit is at about 6.4% of GDP. France ousted its government with a no confidence vote because it was trying to reform Social Security.